Welcome back to the Wolf of Queen Street podcast series. Welcome back to the audio podcast or the video series if you join us today. Before we get going, I just want to do a shout out to my sponsors, Six Figure Secrets. These are guys and girls that help you take your business to the six figures and further if you need help in social media, branding, or even just as simple as running a Facebook ad effectively to return a customer at a lower price point than you would be doing it if you do it by yourself. If this sounds like something you're interested in, you can find them at sixfiguresecrets.co. But today I'm joined by Matt Harris, the director of the Lighthouse Financial Services, a sort of a company and brand that has quite a few companies underneath him. It goes and looks into the property space, accounting space, brokerage space. But fundamentally, Matt himself is a property accountant or accountant that specializes in property. And I'm happy to have you on the show, Matt. Welcome.
Thanks, Lawrence. Good to be on your show.
So as I said just in the beginning, you know, the Lighthouse Financial Services covers a couple of companies or entities in itself and specializes in a few key areas. Do you just want to give our listeners a bit of a breakdown of that before we get jumping into the show? Sorry to interrupt the current show, but just to let you know, if you're enjoying what you see, make sure you hit the subscribe and like button. So next time another episode comes out, you'll be able to see it first. Back to the show.
Yeah, sure. Look, really broadly, the concept behind Lighthouse is that we can offer a number of different services covering residential property investment, lending and insurances, and also general business accounting under the Lighthouse umbrella. But we have some really important sub-brands, property tax returns being one of them, which is one of our large businesses which looks after property investors, and then we have a mortgage business which I think some of your listeners even have utilized, and then we have an accounting that looks after business accounting primarily. And we kind of, the idea being that, you know, if you're a business owner and you want to invest in property, we can help with that. If you're a property investor and you're going into business, we can help with that. Yep. So that's the general premise of it.
That's great, Matt. Thanks for that. So today we're going to be focused, all the listeners, around accounting side and numbers, fundamentally around the New Zealand market and New Zealand properties in that point. And the first question, Matt, I had to yourself is, how does the New Zealand intention-based tax system or regime work for properties?
Yeah, look, it's a great question. New Zealand's intention-based regime has been around for a long time, and it really comes from the fact that we do not have a capital gains tax. If we had a capital gains tax, actually probably things would be quite easy. Everything's taxed, move on with your life. Not the case here. So we have this intention-based regime, and look, at its core, what it says is your intention when you buy a property will dictate how it's taxed. So that's the overriding principle. So if I'm a property investor and you know, under the Lighthouse business, we spend a huge amount of time working with property investors, and I love it. I couldn't think of anything I'd rather be doing. But we have a property investor comes in, and they usually fall into one of two categories. They have not really any idea, or they have some idea. What we've got to say to them is, hey, what are you intending to do with these properties? Are you intending to hold it for the long term? If so, it's going to be taxed one particular way. Are you intending to hold it for a short term? It's going to be taxed a totally different way. So fundamentally, intention's one of those things that is quite fluid, and anyone who's spent a bit of time buying and selling properties over the years will know that it can change, and it does change. So really what you've got to do is make a decision up front and try and stick with it.
So would this be to a lot of people that are not as in depth in this detail would know and relate it to the white line? What's it, the white line test or something like that?
The bright line test.
Bright line. Sorry, there we go. I knew it was.
Close enough. So obviously the bright line test is relatively new. That first came in October 2015, and at that stage it did actually three key things, which a lot of people will know that when it came in, and you had the 2-year period where if you bought and sold within 2 years, regardless of intention, you paid tax. But there were two other things that came in there that I'll just really quickly mention. One of them was that for all property transactions, you needed an IID number. So it's hard to believe actually before October 2015, you could transact on a property without an IID number. This is so commonplace now. And then the other thing that came in is they brought in residential land withholding tax, so RLWT. And what their inland revenue was trying to do was to plug the gap from offshore sellers who would come in and buy a property with whatever intention actually, but they would leave the country without paying tax. So the bright line is a supplement to the intention-based regime. Intention-based is the overriding theme of it. Your intention when you purchase dictates the tax.
Yep.
But if you, regardless of intention, if you buy and sell within 5 years, it's a de facto capital gains tax. And I say it's a de facto capital gains tax because we don't have it. Our legislation doesn't allow it. It turns it into a revenue tax, but most people can relate to a tax on the capital.
So, just in the beginning, you mentioned about there's two forms, right? If you buy and hold, or you buy and trade. So trade, shorter term factor. And you mentioned that there's two different taxes behind it. So sort of the taxation of long term and short term. And you said there's differences. Can you take us through, those examples and differences around the taxing of short term trade and long term hold?
Yep, absolutely. So if you come into my office and you say, hey, Matt, I want to build a portfolio, I would usually ask you a couple of questions, what sort of property you're after, have you thought about the cash flow, that kind of thing. But ultimately, what I'm really interested in is, do you intend to hold this as a long-term venture, or are you going to sell this quite quickly? So imagine you come in and you want to buy a property and you intend to hold it for the long term. The long term is now obviously anything more than 5 years, which is the current bright line period. So a long-term investor is a pretty simple taxation basis. There's no GST. So GST is not levied on residential buildings, and that's simply because the government doesn't want to levy GST on rents, which makes sense. So you do not claim GST, you do not pay GST, it doesn't exist in that spectrum. If you hold the property for longer than 5 years, which is the bright line period, you do not pay tax on the gain. So all you're left with as a buy and hold investor is tax on rental income. And rental income and expenses are pretty well defined in this country. We have rental income being obviously the main income type. Then you have rates, insurance, interest on money borrowed to invest, accounting fees, legal fees, property management fees, and just the list trickles down, and you have a net profit and it's taxed. How much tax you pay will depend on the structure and the tax rate of the people involved, but ultimately it's fairly simple. So if I'm going to look at a buy and hold strategy, it's cash flow, it's capital gain over time, there's no income tax on the gain, there's no GST, you're really only taxed on a very little bit. So ultimately the wealth creation tool, buy and hold investing, is really great. If you trigger that bright line period, not very desirable. It's if you buy and sell within 5 years, it's like kicking an own goal. You pay tax where you wouldn't have otherwise. And we hate own goals and tax, and everyone hates them in general. But there's only 3 exemptions to the bright line, just for completeness for everyone watching. There's owner-occupied houses, unless you have a pattern of buying and selling them. There is matrimonial rollover relief. So if you have to split up with your ex-spouse and roll it over, it doesn't get taxed. And there's inheritance. So if you inherit a property and you sell it, no big deal. You can sell it straight away. And that's simply because New Zealand doesn't tax inheritance. So really, really narrow. So if I'm looking at a buy and hold investor, effectively you can assume that you best be holding it for more than 5 years, and you're not going to have much of a tax drag. On the other side of the coin, if you're someone who comes into the office and you're intending to buy and sell property, so you're referred to in a couple of different ways by the Inland Revenue Department, you're a dealer, a developer, or a trader in land, or fundamentally the same, but a little different. In that case, you have a short-term intention, and before October 2015, it was very hard to distinguish, but obviously now with the bright line rules, 5 years is quite a long time, easy. In that case, you are entitled to claim GST on the purchase price. So it's 15% of the purchase price, and you get that as a refund in your pocket. So GST is a bit of a double-edged sword for those investors. You can claim it, you get a big refund, you use it to pay for builders, painters, carpet layers, all those guys. You get to claim all the GST on that. So it's really helpful. But then obviously when you sell, you have to pay 15% of the sale price back. Yeah, exactly. So you're already automatically 15% out of pocket.
Yep.
Then you have to pay income tax as well. And that's because your intention is to move from that long term to that short term. So if I look at the buy and hold side that we touched on before,
yep.
There's virtually no taxes. It's passive, no GST, no capital gains, very, very low tax drag. On the other side, it's active, there's GST and there's income tax. So, they are vastly different ways. Trading is taxed very much like a business would be taxed, and buy and hold is in the eyes of the Inland Revenue, in most cases, almost not even a business.
Yep. I mean, that gets me into my next point, Matt, at the moment is, you get the two different paths. You get the person, a speculator that flips properties, runs and wants to make quick money every 6 to 9 months in that property game, or the person that buys for the long game for 5, 15, 20 years, and so forth. This rises up and brings up the difference, fundamentally has changed the game of property investing, but it also has brought out the rise of the professional investor. So, 10, 15 years ago, outside of maybe the 1% of the 1% that they were playing the property game, there was very limited amount of people that got into the property game as such. If you look at it now on social media, there's so many people that are now property investors by job title or by the title they've imposed on themselves. Owning multiple properties, flipping properties, or long-term hold, two different strategies as well. And obviously it's changed a little bit of how the businesses need to focus, or you guys need to look into, seeing that it has swung both ways all the time at the moment. So how do you see it and the change of the professional investor over sort of the last 5 years?
Look, I actually couldn't agree more. The rise of the professional investor is something that I've watched for the last couple of years. And when we use, at least in my office, when we use the term professional investor, we don't necessarily mean someone who wears a suit every day and goes out and professionally bids at auctions. The people that have a plan, and whether they're buy and hold or they're traders, they have a plan. So they've thought about the type of property they want to buy. They understand the metrics of that. They understand their own financial position. They know the numbers, and they've hooked up with accountants, lawyers, property specialists, people that can help them achieve those goals. And this is I've been doing this for coming up 16 years, quite a long time. And in the when I cut my teeth as a property accountant, and originally at Inland Revenue actually, before and after the GFC, which was a really interesting time for property. You had two types of investor there, and they were really miles apart. You had the property developer, and then you had the mum and dad investor. Property developer was often being a professional. Mum and dad investor, literally, the only reason they had a property was usually either they had an owner-occupied house to begin with, they'd renovate it, the Kiwi dream, as I used to call it back then, when you renovate a house, revalue it, you move to your new house, you keep that as a rental. You haven't thought about the structure, haven't thought about the metrics. Maybe you renovate again, have some children, you buy a beach house, one more renovation, you end up at your final house. And the Kiwi tree, for lack of a better way of putting it, was really the way that it happened. And so now we don't have that anymore for a couple of reasons. One, that the people have access to education, the internet, videos like this, that you can learn so much, and I watch them all the time. And also, more than that, the property prices have increased significantly. So the Kiwi dream might even be out of reach for a lot of people if they don't go about things in a more structured manner. So I really enjoy it. As someone who's just maybe a tiny bit obsessed with property investment, I really appreciate it when people come in the office and they've at least got an idea of what they're trying to achieve, and they haven't just bought a property and stumbled onto the next one and kind of hope for the best. But it's just not going to work anymore in this environment.
Yep, totally. One thing I want to say to the listeners, the watchers at the moment, as you're talking through at this moment, we've obviously got a couple of examples of investors or property owners, or how to do their taxation and so forth. There's nowhere are we saying that you should be long-term holders or you should be flipping of properties. Fundamentally, there's two sides of the coin, and you can follow either side or both sides if you want to. So nothing that's been said at the moment is saying, hey, we need to only support long-term holds because that's better because you don't get taxed. But so don't do the short-term game. The short-term game is very profitable, but you got to look into it because you are going to be giving away actually a lot of that money. If you can hold on for a couple more years, you're not giving away as much money. But again, like I said, there's totally two different sides of it. So don't feel if you're watching this that we're going, oh, do it one way. You can do it both ways. And fundamentally, you have to take the guidance from from the likes of like Matt, your accountant or your property specialist, to show you which way is the best way to do it with your approach.
Yeah, absolutely. There's a place for all types of investing, and that's what makes property so great, right?
Mm-hmm.
You can do it so many different ways. There's so many ways to add value, different property types, different lenders, and definitely there's a place for trading. It's cash flow, it builds equity. Some people just love it so much they do it all the time.
That's great. So one thing I wanted to find out from yourself is there one strategy, like we said at the moment, we spoke about there's multiple different types, different sides of the coins, different approaches that people can take. But is there fundamentally one strategy that could work for all investors? That no matter which path you're going on, if you follow this simple, whether it's simple or not strategy, it could benefit everyone.
Yeah, well, look, believe it or not, there actually is.
Mm-hmm.
It does lend itself slightly better to buy and holds, but it works equally well for traders. And I don't know what people refer to it, but in our office we call it incremental gain over time.
Mm-hmm.
And it's a pretty simple concept. So it starts with buying well. So if you're a buy and hold investor or you are a trader, whatever you do, you've got to buy well. So that's trying to find properties that are undervalued, that have subdividable potential, minor dwellings, whatever it is. There's lots of different reasons why property can be bought well. That's first part of an incremental gain. Second part is to add value. So a buy and hold investor, for example, adds value by adding dwellings, by renovating, recladding perhaps. A trader will add value by doing subdivisions, by building houses, all those things. So those are two parts of incremental gain, add value. Next parts are maybe a little more towards buy and hold investors. So that is the increase of rental income over time.
Yep. And
the decrease of mortgages. So table mortgages, obviously P&I will reduce over time.
Yep.
The next part is capital gain. So capital gain will occur for both parties.
Mm-hmm.
It will occur for buy and hold investors, and it will also occur for traders. But traders, obviously, their capital gain period is quite a bit shorter. And then the final part of that is tax drag. So if you can minimize your tax drag on transactions, so if you're a buy and hold investor, that's getting all your deductions in, home office expenses, etc. If you're a trader, that's getting all the costs of bringing that property to sale in. And what happens is incremental gain over time is what makes property investors wealthy. So there's no get rich quick in property. Generally, it's get rich over time, and it's let incremental gain occur. So incremental gain, to illustrate how well it works, if you get rid of the business part of it and you just look at your house, your parents' house, your own occupied house, you look at what you bought it for, and you look at what it's worth now, and you look at the reduction of your mortgage over that time, that's incremental gain in play.
Yep. And I definitely agree. I mean, you hear stories all the time of like, our parents of, we bought our first home at, $20,000 or $15,000. And then the next generation, we bought our first home at, $300,000 or $400,000. And what it is, it's just over time, every single thing goes up. As does in the world, but the value does grow. And we're lucky enough we're in a country that the value grows more than what the inflation grows. So you're not actually losing. We're not actually losing money yet. Or in some places it is. So that your incremental gain is positive. It's not negative, because obviously incremental gain can be both ways. You can still grow in value, but your inflation could be higher of a percent point, and therefore it's not worth as much anymore. And that's sort of where you find in third world countries where that happens. There's no point in buying or owning properties, because as soon as you pay $1 for it, tomorrow it's worth 99 cents. The day after it's worth 98 cents. So there's just no benefit from that.
Yeah, I agree. And one of the things about incremental gain is that property investors, the good ones over time, they'll figure out how to speed that process up. And the key to being a really successful property investor is speeding it up. So everyone gets that gain over time, as I
Yep.
illustrated even with your own home. But if you're a property investor who's trying to make moves, multiple properties each year,
Mm-hmm.
you're trying to do the classic buy, add value, revalue, buy again.
Yeah.
Really what that is incremental gain being sped up, and the ways that you do it are finding those undervalued properties, leaky homes, reclads, subdivisions, minor dwellings, adding that value, going back to your lender and saying, hey, it's now worth 200,000 more, can I have 70% of that as a loan, and it's a pretty simple mandate to follow. If you understand incremental gain, then you can start to speed it up, and that's where a lot of our clients get a lot more success.
And I love that, it's showing that it's the same path everyone's going to take. It's just the person that's paying attention to the 4 or 5 key points that you mentioned underneath it, of if you speed one of those up, you're going to get quicker to the end, of whether you want to grow by 100 grand over 5 years. It might take you 5 years, it might take the other person 7 years, because you push something different. And it could be as subtle as you change your rent by instead of 1% raise, you did a 2% raise. Instead of a 3%, you went to 4, and paying the small of the principal off, and sort of those decisions. But again, it's up to everyone's individual path, and to listen to the consultants and the people that are mentoring or guiding them in their path of what's the best approach, because my goal and your goal is totally different. But fundamentally, we are roughly going in the same direction.
Everyone's got to run their own race, Lawrence.
Yep.
That's the key to it. It's easy to look out there and go, this guy's done this and this guy's done that, but at the end of the day, you've got to run your own race. But I'm glad you mentioned rents, because I just want to jump in here quickly.
Yep.
New Zealanders, we've got about 2,000 property investors on our books, quite a lot. And I can tell you, New Zealanders are notoriously bad at raising rents.
Mm-hmm.
If all our client base went out there and raised their rents at least in line with inflation, which is generally about 3% a year, the incremental gain equation over those 2,000 clients would add a huge amount of wealth. So, if you're a property investor and you're watching this and you haven't contacted your tenants and you're a good landlord and you look after them, most tenants will bear a 3% increase all year long, no problem.
That's great. I'm in one situation, I'm one of those people. I'll put my hand up. In one of my situations, there has not been a rent change in a handful of years. So yes, I need to look at and make that example of the 3%. So hopefully, over the next couple of weeks, I get that sorted. But that leads me into my next point at the moment, Matt. We're talking about, again, everyone's past and everyone's journeys and how you can change to get yourself incremental growth, to change on your rent and stuff. But it all fundamentally comes down, and we both been to events, Robert Kiyosaki and so forth. And one of the strongest things there is understanding your numbers, understanding your values, your numbers, what the property costs, what it costs to run, what it costs to sell. Underlying, fundamentally knowing everything is on a spreadsheet. So when you look at a property, whether you're going to buy it to flip it or buy it to long hold, you can know at that point your numbers that stand behind it.
Yep. Look, numbers are really, really important, and not just because I'm an accountant. I think that, the moment that you misunderstand your numbers, you're going to be in trouble. And I see it quite commonly, actually, with traders who have run their numbers, but they haven't accounted for the GST correctly. So if you're a GST registered trader, you take the GST out of your numbers and you account for income tax. But if you don't get the fractions right, 2 times 23 is the GST fraction, I think, currently. If you don't get those right, and you're dealing with bigger numbers, so all the time with property, right, we're dealing with a couple 100,000 at the minimum most of the time. So it's really easy to have the numbers go a bit south, and what that really does is it erodes your margin really quickly. So first of all, if you're a trader, know your numbers, know that you can claim GST, and make sure that it's not going to be a zero rated transaction, for example. And then know what tax you're going to pay, and maybe we'll get enough time to talk about structures at some stage. But ultimately, the numbers and the structures go together. If you've got a profit of 100 grand and your tax drags 33%, then you're going to pay 33,000. If you've got a profit of 100 grand and your tax rate is 10.5%, which is currently the lowest rate in New Zealand, so it may not be there. But just for example, your tax is 10,500, so there's quite a big difference there. So that's on the trade side. On the buy and hold side, what we're really dealing with most of the time is either gross yield, which is just a representation of the rental income divided by the purchase price. It's a good indicator of what one property's value in terms of rent roll versus another property will be, but it's not great. A net yield's a bit better, which is when you take the growth, all the rental income, you take away your expenses. That's an indication of actually what sort of money you're going to make on a property over time. And generally anything above 1%, in my mind, is quite good, because New Zealand's come from a history of negative yield investors. Slowly, because they're becoming professionals, and moving to the positive yield, because they're realizing that it's much better to make $1 of profit than it is to make $1 in loss and get a little refund. And we've also had ring fencing now, which stops that. But when the banks look at it, for argument's sake, they're probably going to add 2 or 3% of margin on that. So you really, if you can get your portfolio up to about 4%, which isn't too hard now with the low interest rate environment, that you can be a bit better. And the other two things that I look at are loan to value ratio, really, really important. That's effectively the amount of debt that you're able to have versus the value of the property. And traditionally, they have hovered around the 70 to 80% mark.
Correct.
Currently, there is no loan to value ratio mandated by the Reserve Bank, which is a bit interesting. But in reality, the banks they're not going to go out there and give you 100%. They are money-making machines, and they want to protect themselves. But generally, if I have an investor, we're looking at a 70-30 if we can. That's 70% bank lending, 30% deposit. But if you also have an own occupied, you might be able to go up to 90-10. So over the two properties, we might be able to work a little bit there to get you a bit more money. So understanding the loan to value ratio is quite important. And then the other two things that people don't understand so well is debt cover ratio, which sounds very difficult, but in reality is really, really easy. All it is the amount of money you make, how many times you can pay your interest. And banks look at that. People don't know that, but banks look at it straight away. They're primarily interested in, are you going to pay your loan? So understanding that's quite good. And then also understanding rate of return, or ROI, return on investment, which when you think about property investment, if you look at a property, imagine I buy a property for $1 million and I put $200,000 deposit down, and then it's worth $2 million in 10 years, my rate of return, or my return on investment, is huge. And the reason that is huge is leverage, which is what every single property investor in New Zealand has at their disposal. It's the fact that I can go to the bank and I can get 70%, but I keep 100% of the gains. So conversely, if I pay for a property in cash, that makes my rate of return the same as my net yield. That is, it's almost useless. If you've got money in the bank, pay down your personal home first. Do not buy an investment with it.
Yeah, I totally agree with that. I mentioned on a previous episode before of, through, X amount of properties, I've only paid for one, which was the first one, with a lump sum of cash. And then the rest of it was just, as you talk about, utilizing the leverage. As we sort of get into the end of today's episode, there's just a couple more points I wanted to cover off before we head in there, is talking about the wealth wheel approach of building a portfolio. I'd like to know your view on this.
Yeah, I love the wealth wheel approach, and it's something that's been around a while, I think. But effectively, what it means is these professional investors I talk about, what they're trying to do is build multiple property portfolios. It can't just happen, because banks look at two things. They look at equity and they look at servicing. And eventually, probably one or both are going to run out. So how investors get around there is using this wealth wheel approach. And what that really means is high value capital gain properties, which are going to be low yield by nature, mixed with medium value, medium yield, mixed with low value, high yield. And so together they create a wealth wheel. So what happens is the low value, high yield property pays for the losses you're going to make on the high capital gain property. And that allows you to keep moving your buy, add value, revalue cycle, and maintain a servicing.
Mm-hmm.
Because ultimately, if you can't get lending, we have a great sign in our office, need money for property. And it's a bit of a play on words, but in reality, all property investors start with the money equation.
Yep.
And they move from there. So with a wealth wheel approach, all you're trying to do is balance out your portfolio so that you don't have all cash flow and no gain.
Yep.
You don't have all capital gain and no cash flow. And it's a really simple concept. If you put in your mind, you can't lose.
That's great. I love that. And the last thing I wanted to cover off, and I know it's something you just mentioned a few minutes before, I'm hoping to get across, is talking about restructuring. And fundamentally,
Yes.
there's a rule that good investors or good people that understand their properties and so forth restructure regularly. I'd like to know, your thoughts behind this and why it's beneficial for people to look at restructuring at a regular period through their portfolio.
Yeah, that's a good one. People, in my experience, people don't look at restructuring enough, and the benefits of restructuring are really obvious quite a lot of the time. So there's a number of reasons that we do it. We will take former owner-occupied properties into trusts and or look through companies, depending. And when we do that, what we're nearly looking to do all the time is bring the cost base up. So for tax purposes, if I paid $200,000 for a property and I spent $100,000 renovating it, the maximum mortgage interest deduction I could get is for $300,000. But we might be 5 or 6 years down the road, and that property is actually worth $700,000 now.
Mm-hmm.
And I might have a owner-occupied house with $300,000 of debt on it, for example. All I have to do is take that rental property and sell it into a structure at market value, and I can leverage it up 100%. I can pay off the mortgage on my own home,
mm-hmm.
and I have the same 2 homes, I have the same 2 mortgages, but I have 100% tax deductibility on my payments. So that's one example of why restructures are important. Also, every time you restructure, there's an opportunity to go back to the bank to get a better interest rate, to get some cash back, to get a mix of both. And then the third reason that we restructure is for tax purposes. So what I see quite commonly in my practice is people who have had, clients who've had rental properties for a number of years, started off negative, interest rates have dropped, rents have gone up, and incremental gain equations kicked in, and now they are positive. And they're in a structure where all the money's flowing to one person who pays 33%, but maybe the wife is looking after children and she's on a 10.5% rate. We can't get the money to her. Mm-hmm. So a simple restructure into a trust, for example, which is able to distribute income to one beneficiary of another, really, really flexible for property investors. We can take that income and reduce the tax drag to 10.5% from 33%. So, it can be thousands every year for the next 5 or 6 years. And tax drag is one of those important things that is part of incremental gain equation. So I think, people should be looking at restructuring just the same way that professional investors move from bank to bank, trying to get a better deal.
Yep. No, Matt, that's amazing. I love that. And I mean, there's so much we've covered off in the last 30 minutes, just so much important for people to think about, to anyone that's listening out there. But before we end off today's show, Matt, can you let the listeners know at the moment where they can find you and how they can reach you?
Yeah, absolutely. So you can visit either www.propertytaxreturns.co.nz, which is our property business. You can email me personally, Matthew with 2 T's, at lighthousefinancial.co.nz. Otherwise, look, I'm on LinkedIn, I'm on Facebook. You Google me, you'll probably find me. So just reach out, and I'm pretty sure even if you tap Lawrence on the shoulder, he'd send you my details.
As always, the details will be wherever you are listening or watching. There will be details for Matt as well. And I just want to say a big thanks to you, Matt, today. I know the audience would love it's coming across from the property space. Understand the insights you provided around the accounting, the benefits, and the pros and cons of doing certain actions. But fundamentally, to everyone, as I always say, that's watching or listening today, if there's something you've picked up that's insightful, if there's something you've picked up that can benefit someone else, please let them know. Tell them to come on over, to come and watch or listen, or just send this, the video or the audio over to them and say, hey, this might help you out in the current situation, especially where we are in the world at the moment of people need the help, need the insightfulness to be able to change stuff, to be able to give themselves maybe a couple more dollars in their pocket. But as always, at the end of the day, stay safe, stay beautiful. Until next time, see ya.